If USA does revalue gold, they've got to value it at a high enough price so that gold flows into the US Treasury. That's what they need. So they need to put the price up, and that's why I came to 15,000, not 10,000. Put the price at a certain level because at 15,000 there'll be plenty of sellers to the Treasury and going to be gathering in all the gold. Meanwhile, China, which has been buying gold every month at the very low price of 3,000, 3,500, with the dollars they've got, will find that for the same dollars, they only get one-fifth of the amount of gold. So we can argue about how much China's got secretly gold stashed away. We don't know the answer. There's a lot of arguments they've got some secret gold hidden away. But in terms of being able to buy more at a low price, they won't be able to. So
if they were to revalue it to 20,000, they'll get about 5 trillion, and 20,000 would be, I think 40,000 would be about 10 trillion.
MarioInnecco puts it plainly. If gold is revalued to $20,000 an ounce, the US Treasury could unlock $5 trillion in Federal Reserve-issued credit, secured by gold, not by adding to the national debt. At $40,000, that number doubles to $80 trillion. That's what people mean when they talk about remonetizing gold, transforming its rising value into actual financial leverage. Innecco also argues that gold isn't topping out. What we're seeing might just be a pause before the next leg up, especially with signs that China is quietly increasing institutional demand. That view gets support from Beijing's recent move to open its first offshore gold vault in Hong Kong. This isn't just about storage. It allows trade partners with yuan surpluses to convert directly into gold through the Shanghai Gold Exchange, thereby eliminating the US dollar from the process. Chinese officials describe the move as a return to classic monetary principles. Where there's gold, there's money. That's not a random quote. It signals a more profound shift toward gold-backed trade relationships and away from dollar dependence. Innecco also examines gold's performance over time to support its case. Since 2008, gold has gained 427% in Japanese yen, compared to just 288% in US dollars. That gap suggests the dollar-denominated price of gold still has plenty of room to rise. Technically, the gold chart reflects a market trying to recalibrate. The price dipped during the last trading session, but bounced back after hitting oversold levels, confirmed by RSI signals. Still, gold remains under pressure in the short term, having fallen below the 50-day moving average and broken out of its recent bullish channel. Until it regains nearby resistance, the path higher won't be smooth, but the broader setup remains bullish, especially when you factor in global macro shifts and the strategic positioning by China. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
China is going full throttle for gold, and the thumbnail says that there's rumors, because it's only rumors. I haven't seen any official story, but there's an old saying about there being no smoke without fire. And this came out yesterday. It says Andy McGuire, from his sources, China increased in June amount of assets insurance companies can invest into gold from 1% announced in February to 2% now. That's 25% of the global mine supply, with possible increase to 10% in 2026. Well, that's the reason why I said it was a rumor, because we don't know, but I think it could be very bullish for gold, because there's talk now that gold is had like a triple top or a quadruple top here. In dollar terms, this purple mauve line is the dollar price of gold, right? And some people are saying it's a triple, quadruple top, and the market's going to drop. And the reason I'm comparing to the Japanese yen in gold is that we've had many of these, like here, 1, 2, 3, 4, 5, and eventually the dollar, the price of gold goes up in yen. You had one here. I guess you had one here in dollars as well, and then it went up. So, and I think the Japanese yen is like a harbinger for all fiat currencies. And if we, let's see, go back to, let's say 2008, which is an important date, Gold is up 427% in yen and 288 in dollars. So I think there's room for upside in the dollar in terms of the price of gold in dollars. I wonder what you think and what's happening now with the price of gold in dollars. I think the stock market is going to go up quite a lot. The dollar is going to go up versus the euro. I think gold and silver might be hit because of this win by Trump against the EU. But I'm not so sure about the future because the stock market is in a melt-up phase, as we've spoken before. I saw, Clive, before you came on, I was talking about a post on X from the White House. I follow it because it's you need to know what they're thinking. And it said that everything's great. The stock market is at all-time highs. Small businesses are booming. We won against Europe in the trade war. And then I thought to myself, so why do you need such deep rate cuts if everything's great? That doesn't add up. And maybe also this deal with the EU, and also did you hear that they've frozen the deadline for the Chinese tariffs for another 90 days? And I think they've done that because China has the rare earths card. But to me, that might put pressure on Powell to cut rates because the White House can argue, well, there are no tariffs right now. We've delayed it for 90 days on China. Go ahead and cut rates. I think that's the strategy there. First thing they've got, basically, after general is gold certificate account, page 12. So this, to me, it shows that for the Fed, that their most important asset is gold, really. They've got it right at the top. I guess not really gold, it's certificates, but I'll show you where it is. So here we go. The Secretary of the Treasury is authorized to issue gold certificates to the reserve banks to monetize gold held by the Treasury. At any time, Treasury may require the gold certificates to by demonetizing the gold. Treasury.
Okay, can we stop there for a second, Mario? So that's exactly what I said in the video I did a couple of days ago, that the Treasury will reacquire the gold certificates, firstly, and then secondly, they'll reissue them at a new price, a much higher price, i.e. they'll put the price of the gold up, and they'll give them back to the they'll give them back to the Fed, basically, at a new price. And that's basically what the word I used to remonetize gold. And obviously, Mr. Bessent is going to do it as well. Sorry, Mary, you just carry on from that. I didn't mean to interrupt you, but I was so surprised to see that. That's amazing.
That's basically they're explaining what you've explained months ago. We've talked about this. So maybe they listened to our video and they said, maybe we need to do this, or I don't know. But it's just the procedures that they have to go through, and each of the gold certificates are issued to each 12 regional banks. I guess in the Federal Reserve Bank of New York, being the biggest one, gets the most certificates, and the smaller ones gets the least. But yeah, I mean, if they, like you said before, if they revalue to 15,000, the Treasury would get four trillion in Federal Reserve credit or notes. But I guess if they were to revalue it to 20,000, they'll get about 5 trillion, and 20,000 would be, I think 40,000 would be about 10 trillion. That's what the Italian guy that I spoke with last week was. He thinks it could be any number, really. And that what that would do, Clive, and you probably are aware of this already, is that it would provide liquidity to the Treasury without taking on any debt. Yeah, I think it's important. The more a country has in gold reserves per population, the better. I think it is. I think Portugal is one of the countries that has the biggest gold reserves as a percentage of foreign reserves. They got 84% of their foreign reserves in gold. I'm not sure. Yeah, and I think they've got about 400 tons, which doesn't sound much, but it's a small country. Switzerland has quite a bit of gold, even though they sold half of it. So yeah, I think it's important. Canada, as a country, doesn't, but individuals have gold as well. Like in India, I think the population has loads of gold. Has it helped India? I guess partly, but India is still a very how can I say? There's still a lot of inequality there. There's a 200 million, 300 million or something middle class, but the rest are really dirt poor in India. So it depends as well. Just having the gold doesn't mean to say the country is going to be prosperous.
According to OCC quarterly reports, the Federal Reserve is exposed to over $54 billion in gold derivative contracts that don't comply with Basel III requirements. If these rules are fully enforced, those positions would either need to be unwound or properly collateralized with physical metal. That's a significant shift, and it's already sending ripples through the gold market. Analyst Clive Thompson believes the fallout could go much further. If gold is revalued and the Treasury steps in with a firm bid, say at $15,000 an ounce, it could spark a massive reallocation. Investors sitting on profits in gold would likely rotate some of that capital into silver. Given silver's already steep undervaluation, Thompson sees it breaking out sharply, potentially soaring past $150 an ounce. He argues silver could even outpace gold in both speed and percentage gains. The context behind this shift is debt, specifically the deteriorating state of U.S. federal debt. Trump's growing budget deficit is making it harder to finance government borrowing. At the same time, rising interest rates are squeezing the real estate sector, which heavily relies on credit. Thompson also points out that some are calling for much higher gold prices, up to $20,000, even $150,000 an ounce. That's extreme, but the reasoning holds. A higher gold price gives the US Treasury more purchasing power while limiting the influence of foreign holders, such as China. It's a strategic move, not just a market reaction. Let's get back to the interview.
They can increase the amount of money they've got to spend. They can reduce their debt. They can keep all of their gold, and their debt will go down instead of up. So the only question is, at what level do they decide to revalue gold? Should it be today's market price, which in my opinion is way too low? Should it be at 3 times or 4 times or 5 times the market price? I think that would be a very good level to try, but it could be a lot more. But there's a lot of arguments for and against each level. And I did my maths on, and it wasn't back of the envelope maths. I spent quite a long time figuring out what I would do if I was Scott Bessent. And I came to the correct figure being 15,000. But 20,000 wouldn't be a wrong number.
Yeah.
And of course, there are people who say it should be 150,000 because that would be enough to pay off the entire national debt. They can start again at zero. If USA does revalue gold, they've got to value it at a high enough price so that gold flows into the US Treasury. That's what they need. So they need to put the price up, and that's why I came to 15,000, not 10,000. Put the price at a certain level, because at 15,000 there'll be plenty of sellers to the Treasury and going to be gathering in all the gold. Meanwhile, China, which has been buying gold every month at the very low price of 3,000, 3,500, with the dollars they've got, will find that for the same dollars, they only get 1/5 of the amount of gold. So we can argue about how much China's got secretly gold stashed away. We don't know the answer. There's a lot of arguments they've got some secret gold hidden away. But in terms of being able to buy more at a low price, they won't be able to. So if America goes in with a big number, they're going to basically win the war on getting the gold. And they'll annoy or irritate their arch enemy, if you like, in a certain sense, China, because China won't be able to get the gold anymore, or at least they'll have to pay 5 times as much. So I don't think it's going to be a wrong number to put it high. If they only do a halfway house, let's say they put it to $5,000, well, immediately the gold price is going to trade at more than $5,000, and trade above the bid, above what they're bidding, and that means that they will not be buying any more gold. Of course, the Chinese will still have to pay more on the international markets to buy their gold, but it won't help the Americans because they won't be acquiring gold because the price will be trading above their bid. If they revalue gold and there's a bid under it at $15,000 per ounce of gold, then a lot of gold will be sold to the US Treasury and people will redeploy that money into other precious metals and mainly silver. Silver will be the biggest beneficiary. So silver is going to go through the roof. It could go further. It will go further and faster than gold. So, 150 would be my floor, and I think probably a lot higher. So I wouldn't be. I'm not saying you're wrong with your $500,
No,
but I think certainly well above $150.
yeah.
Well, it's interesting. The pattern you've shown me for gold is quite similar to what we're seeing in some of the major indices and commodities and Bitcoin, funnily enough. So one wonders if everything's kind of moving in tandem. We're getting to a slowdown point. Okay, gold is at an all-time high, as near as makes no difference, so is the stock market, but they all seem to be sort of stuck at this very high level temporarily. So traditional technical analysis says that this type of pattern indicates that we're in for a fall, but it's not always so. But obviously the chances of a fall are higher when you see this pattern than when you're going straight up as we have been doing so, then the chances that it continues going up are quite good. The chances of a fall are quite slim. But when you see the sideways movement, the chances of a fall are much higher. Now, I still think the chances of a fall are only 50-50, but that's higher than maybe the 30% I would have said a few months ago. So those who want to trade it, if you're a technical analysis, go ahead and do so. But I certainly wouldn't recommend anybody try coming out of gold, especially when you look at your chart there. You see that after every pattern, which is like this, it then has its flat period, goes down a bit, and then it takes off again. And the question, if you come out, what are you going to go into? Are you going to go into cash, something which we know is being depreciated? So you're going into something which is, you're betting against a known depreciating asset. First of all, the market has been completely ignoring this end of August deadline where the tariffs are going to come into hundreds of countries. I know they've negotiated with a few countries now and also the European Union. But end of August, this is supposed to be a hard deadline. So I think, first of all, on Wednesday, we'll have the announcement about the Federal Reserve interest rate policy. The market is expecting, and I think that will happen, that they'll keep interest rates steady. There'll be no change. But they'll probably signal in a certain way that there will be a cut at the end of September. And if they do so, that would be give the market something to cheer about. And then, of course, we got a few days later, we got the end of August. I think it's Friday, isn't it? When this tariff deadline comes in. It wouldn't surprise me one little bit if he doesn't extend it another 30 days, 90 days, to give all these other countries a chance to negotiate with the USA. I think there's still another 200 countries or trading partners, is what I read, they have to negotiate with. So an extension of that would give the market another excuse to keep going up. And then, of course, come September, they probably will cut the rates, and who knows what effect that will have. It'll probably push the market up again. So, the market's in the mood. Right now, the market's very much in the mood to go up. I think things have become a little bit overpriced. They've lost touch with reality. It doesn't mean to say every stock in the market's overpriced, definitely not. But the ones which most people own are overpriced. If you buy an ETF, you buy an S&P 500 ETF, you're going to be very heavily exposed to the Mag 7, which have got quite high multiples by historical standards for the growth they're going to deliver. Obviously, we know that from historical reasons, things which are overpriced can continue much longer than we expect can continue for years. But you're not getting a lot of value for money if you buy the S&P 500, so that means the whole market is a little bit overvalued. But I think the market's in the mood to go higher. The money's there, people have got it, and they're looking to deploy it. They don't want it in cash at the moment with everything which is going on. These insurance companies in China must be saying to the government, look, can you give us a little bit more flexibility here? We want to diversify into something which is basically not fiat. And obviously one of the fiat assets that companies all around the world hold They're basically bonds, dollar bonds, and then they often, for exchange rate reasons, hedge it back to the domestic currency. That's a fairly common thing. And the reason they invest in US dollar bonds is because, in general, you're getting a higher rate of interest on the dollar bonds than you're getting on the domestic bonds. And if you hedge it back, you're still making a positive return, which is more than you get by investing in a domestic bond. That's, in a way, exploiting the difference between long-term rates in US Treasuries and short-term rates available domestically in most countries. So, everybody wants to increase the returns. I think now they're in this situation. They've got all these dollar bonds, and they're saying, well, we've got too much of them. We want something else. And obviously, the gold is a very good place to park your money right now with everything which is going on.
Credit markets are tightening, sovereign debt looks less reliable by the day, and monetary anchors are starting to shift back towards something tangible. The structure of global finance isn't collapsing, but it is being reweighted. Precious metals are no longer just hedges, they're being positioned as foundations. And if policy leans further into asset-backed credit, we might be watching the early stages of a monetary regime few are truly prepared for. What happens when confidence in credit hinges less on promises and more on what can be weighed? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.